Hi. Today we're going to talk about the game of business, some core financial fundamentals. And at the end of the day, think of it this way. We're going to talk about COC, which is the cost of capital. Just think about that as how much does it cost to play the game of business? How much does it cost to get the cash, play the game of business? And RONA is the return on net assets. We'll explain that in a bit, but that's basically, well, how well did we play? At the end of the day, the concept is simple. If how well we played is equal to or better than what we promised to pay back people in order to play, we can go back for more money, right? So there's a cost to play. How much is it going to cost to get the cash to play the game of business? And then how well we played. And if we can pay back the people that we got the money for, both shareholders and debt holders, the amount that they expected, we can go back for more. And if we can't get them back what they expected, the cost to play, well, we're going to have trouble going back and getting more money. So let's just start real simple on this game of business. I'm going to start real simple. And simplistically, if you think about it, let's just picture you won a lottery ticket, right? $100,000. Right now, different people have different percent. It's $100,000. And you got two friends, and they give you, one friend works as an entrepreneur or a would-be entrepreneur, and they say, hey, guy, look, Dave, you know how good a hairdresser I am. Man, loan me that $100,000 if I can start my hair salon. You know how good I am. And at the end of the year, I'll give you back $105,000. The banker friend says, whoa, before you do that, give me the $100,000. Put it in the bank. I'll invest it in the bank for you. And at the end of the year, I'll give you back $105,000. Now, in that situation, which one are you more likely to take? A bank. Why? Risk versus reward. I mean, that's the key to business. The higher the risk to where the money is, either you giving it or you getting it, the higher the risk to the person giving you the money to play the game of business, the more reward they're going to want back, right? Higher the risk it is, pretty simple, the more reward they're going to want back. And that's at the core element. So how does this all happen? Well, in a somewhat sophisticated business, it's pretty simple. What are my investment opportunities, right? And what's that based on? Well, I've got some internal strengths, capabilities, and I've got some internal weaknesses, right? And there's some external opportunities out there in the marketplace and some threats in the marketplace. And based on those, I see some opportunities for investment, right? I want to invest in what I call my sledgehammers. That's where I've got an internal strength. And there's an opportunity out there. And if I can invest in these certain resources, I can take advantage of that. And those are the best investments. And I get some investments where I got an internal weakness and this is an internal threat. But if I put a few resources towards it, I call that investing in protecting my Achilles heel. These are good investments. But each one of these and each one of these options has a different risk versus reward profile. And that's where I want to invest money. And I invest those based on, if it's a higher risk project, I'm going to want a higher return on those monies I invest in those resources. And if it's a lower risk, well, I don't require as much return, right? So what does that mean? All right, well, the cost of capital, I had to go get money to play the game of business. And where am I getting that money? I'm getting it from debt, banks and bonds and whatever, and I'm getting it from shareholders, right? I need to play the game of business. And they're going to say, well, based on the risk of your business, I need this much return. Now, debt holders, their requirement of return is a lot lower than shareholders. Why is that true? Well, think about it. One, if there is a problem with the money, debt holders get paid back before shareholders get anything. That's one reason debt costs a lot less than shareholders. Two is, well, debt is constantly getting paid back, so it's constantly reduced, so the risk is continuously going down. Shareholders, on the other hand, only get money back if the corporation decides to pay dividends. So the cost of equity is from dividends or the future value of the stock. Cost of debt from the interest rate. Debt always costs less. And so you're getting some money from debt and some money from equity to play the game of business. All right, so let's try that. Let's assume you have $30 million in long-term debt. And let's say you have $10 million in paid-in capital, the amount of cash that shareholders put into the business. And then there's $60 million in retained earnings, which is the amount of profits the business left in the business. So you get a total of $70 million in equity. And let's just assume for this little exercise that debt on the level of risk for your business says, I need a 6% return interest rate to give you that loan. And let's see, equity says, this is higher risk. I need a 15% return on my investment to justify the loan, to justify investment. And let's just assume for this, your tax rate is 35%. Now, these percentages are not way out of bounds of most small businesses. Maybe a little higher, a little lower, but in the ballpark. So, under getting money to play in this particular example, the total investment that's invested in my company is 30 million from debt and 70 million total from equity for a total of 100 million. So what's the mix? Well, of that 100 million, 30% is from debt and 70% is from equity. All right, so what does that cost me? Well, my cost of debt is my 6% return, but I get to deduct that as an expense. And if I'm in a 35% tax bracket, it means it really only costs me 65% of that 6, because the other 35% is a deduction. So my real cost of debt is around 4%. My total cost to play the game of business. Well, 30% of it I'm paying 4% on, and 70% of it I'm paying 15% on. So my cost to play overall is 12%. It cost me 12%. I'm promising the return of 12% in order for them to give me the money to play the game of business. So the first question to ask yourself is, as a business person, from the cost of playing side, how can I add value? Well, the more that you can convince where you're getting the money from, the shareholders, might be yourself, or the debt holders, banks or bonds or whatever, the more you can convince them that the risk is lower than they thought, the return that they're going to require is lower, therefore the cost is lower. So on the cost of money to play, you've added value because you've lowered it. Let me give you a quick example. These are just some averages out there in the country. They're not exact, but I found this is data. So let's take a typical public utility, right? The cost of debt really a lot lower than most because the risk is next to nothing. It's like, so the banks only require about 3% return on that money because it is safe money. And equity, they know, the shareholders know, this ain't going bankrupt. This is a really safe bet. So they require a 7%. It's low risk. And because it's generating cash month after month after month, debt holders know they're going to get paid. And there's enough cash being generated to pay. So they're willing to put up 80% of the investment needed. So 80% of the money needed to play is from debt, and 20% comes from equity. So if you multiply the 80% times the 3% cost and the 20% equity times the 7% cost, it costs public utilities about 4% promised return. And if they can make an investments that at least return 4% or more, they can keep going back for more. Okay, let's take a manufacturer, for example. A big one, solid one, their debt might be 4% cost. And by the way, this is debt after deducting the tax deduction. I mean, these debt numbers are net of paying, the tax credit. So in equity, well, manufacturer's a little more risky, call that 10%. And a big solid manufacturer, it might be a mix of 60-40. So if I take 60% of 4 and 40% of the 10, well, the cost of playing for manufacturers, 6.5%, 7%. So that means if they can make an investment, they're going to return at least that much, either in new equipment or a new business or an acquisition, whatever. They can generate that much or more, they can go back for more. Retail, it's a lot higher, it's a lot riskier, which is why usually they can't get as much debt because it's riskier. Debt holders are worried they're going to be able to make their payments. And high tech or new businesses, it's typically closer to 20 or more. And you usually get very little in debt on high risk businesses or entrepreneurial businesses because they're high risk. So typically most of that money comes from equity. If it's very high risk, those investors might want closer to 25%. So if I take a successful entrepreneurial business and I ask even the owners who put in the money, what return are you expecting on the money you put in? Because you've taken a risk and you got to try to sleep at night with that risk. And I usually hear between 15 and 20%. But the key point is most businesses, most entrepreneurial small businesses, their cost to play is generally, as a rule of thumb, in the 15 to 20%, based on what it costs for the debt and what the shareholders or owners of the company are expecting based on the risk they're taking. All right. Now, you may be asking yourself, well, Dave, if debt costs a lot more, why won't I just use mostly debt? A good question to ask. The reason is debt gets capped. Debt holders, why would they cap it? Well, one, the way they do it is they say, okay, let me predict your monthly cash flow, which will tell me, will you be able to make the payments? And a proxy for that is EBITDA, earnings before interest and taxes, but add depreciation back, because depreciation is not a cash expense. So that sort of tells them it's a cash that's being generated. And what they'll normally do is they'll take a very conservative, super conservative view of, man, if the business turns down, if the economy turns down and things aren't going well, what do I still think they'll be able to make monthly to be able to pay the dividends? And that's one reason it caps. It caps to very conservatively because banks don't want to lose anything. What am I almost certain they'll be able to pay me each month? That's one reason for a cap. The other reason for a cap is this, especially a company that is more acquisition oriented. And here's the reason why. Debt, a good solid company can work with the banks or bonds and get it pretty quickly. But if they want to sell shares, it just takes a lot longer to do. So if I'm acquisition oriented and want to be opportunistic, I don't want to use all the debt I'm capable of getting. I want to hold it. So when I need it, I don't want to pay for it until I need it. When I need it, I can just go to the market, get the debt, and take advantage of an opportunistic acquisition or buy a piece of equipment or whatever it is I want to do, right? And that's called debt capacity. I'm holding back some capacity to get debt because I can get it quickly, right? So that's how much does it cost to play? Now, next piece is, how well did I play? Got the resources to play. How well did I play? And that's called the return side. So the cost of capital is the investment. And then there's the return, right? How well I played. So where's that come from? Well, that comes from the income statement. And basically it's the sales And then you subtract from that the direct cost of the products and services that went into those sales. And that gives you gross profit. By the way, little thing, gross profit technically is always in dollars. Gross margin is always a percent, right? I take that, then I subtract from that, called SG&A or general expenses. Those are the expenses to run the business, but I don't directly associate with the individual sales that got made. It's overhead, it's general expenses, same term. And when I subtract that from the gross profit, I get my operating profit, right? And then, well, I might have some non-operating income. That's income that some companies have that's outside of how they typically operate. So let's say I'm an entrepreneur and I have an extra dump truck. And I decide, you know what? I'm not using it right now. I don't need another one for a year. I'm going to sell the dump truck. And I make a profit on that dump truck. I might go into non-operating income. And that's now going to give me my earnings, my profit before interest and taxes, right? Sometimes called profit, sometimes called EBIT, sort of the same thing. My profit for interest and taxes. Then I subtract my tax. I get my profit after tax. It's the profit that's been generated that's really left, the return. That's how well I played, right? I got what did it cost to play and return. Let's go into that just a little bit deeper, right? So let's just think of a balance sheet. Think of the balance sheet is that's the investment, right? That's what shows me in paper how much is invested in my company. If you look at it, what is that? Well, I got my short-term assets, and I got my long-term assets. That's 100%. And that has to equal the other side of the balance sheet. That's my short-term liabilities, which is like payables to my the people providing me my supplies and things I need to make my products and whatever. And it's my short-term debt, which is to cover like inventories and receivables, whatever theoretically. The bottom side of that side is the investment side. If you think of short-term liabilities, they're not really investors, not really at risk. They're just part of the overall operating part. But the investment side is from the long-term debt, the equity. The equity is paid in capital, the cash the investors put in the business or the owners put in the business. And the retained earnings is the profitability that the owners didn't take out of the business. They reinvested it in the business, right? So here's the equation. If I take my total assets minus my short-term liabilities, that happens to equal my investment side, right? If you look at that, my net assets, total assets minus the short-term liabilities, happens to equal the investment side. So what does that mean? Well, the investment side is really the same thing as net investment. Net investment, total assets minus short-term liabilities, happens to equal true investment, long-term debt, plus my equity. It's going to become important in a second, right? So the net assets is what was invested, or the total investment, net investment, is the long-term debt plus the equity. Either way, the same equation. So what does that mean? My return on net assets is the same thing as saying return on to the investors in total is my return on investment. Okay. The top number comes from the income statement. It's the profit after tax. And if I divide that by my net investment, which is my total assets, less my short-term liabilities, which is the same mathematically is my total equity and my total long-term debt. That's RONA. And in total, that reflects how well I played the game for the group that's invested in my company, debt and equity. That tells me how well I played the game of business, right? And if I play the game of business and get a higher return, the RONA, than the overall cost of getting the cash to play, I can keep going back for more, right? And that's why at a senior level, I mean, you may have memorized all these different formulas, accounting formulas, whatever, but at the C-level suite, at the ownership suite, those who understand the game of business understand RONA is making sure I'm getting the return needed as I play to be able to give back what it costs to get the money to play. And if I can keep that equation working, I can keep growing. And then an individual investor, the shareholders themselves, they now look at return on equity. How much did we actually get back return for the shareholders? All right. So next part, EBITDA. And why and where would I spend time worrying about EBITDA? And I'm just trying to show you what the more sophisticated players like on Wall Street, they look at a lot of stuff. But the primary ones are RONA, whole group of investment. How well I play, can I play that back? Return on equity, well, for our shareholders specifically, what's my return? They also look heavily at EBITDA. And EBITDA is basically my earnings before interest and taxes. I add back depreciation because that's not cash on that income statement. It's the only thing on the income statement that's not cash, right? So now I've got my EBITDA, and this approximates the cash flow that I have. And at a senior level, at an owner level, hey, the real decisions I get to make mostly is with cash, I can do stuff. And without cash, I can't do that much. So what might I do with that cash? One is I can pay back loans with it. Two is I can invest it back in the business. Three is I might pay some taxes. Four is I might buy back some stock, but hopefully, and usually, it's about I might pay back dividends or I might reinvest in the business. That's typically what it's mostly about. It's the cash, right? So quick summary. In a nutshell, the game of business. I get the cost to play, right? Comes from debt, shareholders, is how well I played for that group, RONA, which is the profit after tax, which comes from the income statement. And the bottom is the investment, comes from the balance sheet. And that gets in my RONA, right? Let me give you a couple of examples. This not only plays out in the cost and how well we played for the company as a whole, but it's typically the same thing, especially in sophisticated companies, internally. So for example, I remember when I was at Johnson & Johnson and I was working on new products and new business, whatever. And there was sort of a rule of thumb I knew there. If I went with them to the leadership with an idea for a new product or business, they generally wanted me to prove that I thought I could get a 35% return. Why? Because they knew they were high risk and as well-meaning and as high all intentions that it's going to all work out. They knew a lot of them didn't. High risk, they wanted a 35% return. I was just adding capacity. Well, that's based on my projection of what the market's doing, and I think we can sell more and whatever. That's still risky because maybe I'm off on my forecast. That's a lot less risky than starting a business because I already have a proven business. And the rule of thumb back then was they wanted a 20% return because they knew sometimes it wasn't going to work out. They may not get their 20, but on average, they needed. And it was a low-cost project, like a low-risk project, like, hey, if I do this, I can immediately lower my cost of goods sold. They didn't need as much return because those are pretty certain investments. I needed a 12. Notice it's the same concept internally, because internally, senior management is playing the role of banker and investor. Am I going to get my return? All right. In terms of business, high risk businesses, generally, Wall Street's looking for closer to a 35%, and supermarkets might be 20, and a public utility, and those may have even come down more, as I shared before. All right. But what's the therefore? This is really key. Once you understand the game of business, you don't have to memorize all the formulas. I can remember in accounting class, I'm memorizing inventory turns and accounts receivable turns. I'm memorizing all these different numbers. What do I do with them? Students, you probably memorized all these numbers. Why and how do I need them? This is all you really, at the end of the day, need to know to add value and to share with your team how to add value, right? I'm just share with them, look, senior people, anything you do that can decrease the cost of getting money to play adds value. Basically, one way to do it, demonstrate to them the risks that they perceive, either perception or real, because you've done something, is lower than they thought. Therefore, they'll require a small return. That's just for a few people in the company. But everybody on your team, in the entire company, just get them focused on a few things. Say you don't have to memorize all the formulas. You add value for this company in one of two primary ways. Anything you do that increases the return, top number, the profit after tax, increases value for this company. Anything you do that decreases the investment in that assets adds value to the company. The more I take down the bottom number, the overall ratio goes up. The more I increase the top number, the overall ratio goes up. And what you find in a lot of companies, most people understand the top number. But most companies, most of the people, sometimes the senior management, don't see much value is on that balance sheet stuff on decreasing the investment side. So all everybody on your team needs to be reminded of constantly is, hey, the income side, anything you do that decreases the cost of goods or increases the sales or lowers expenses, you've added value. Any of those three things adds value. 2, anything that you do that decreases the investment, either decreases the assets or increases that short-term liability side, right? The payables, someone else is now sort of giving you money. Anything you do that net assets that lowers it adds value. Again, remember the denominator, bottom numbers from the balance sheet, that's lower the investment. And the denominator, wrong, I apologize, comes from the income statement and spotlights the increase return. All right? A few more things. You don't need to know this, but just because some of you I know at this point are probably wondering, well, all these numbers, who cares? Well, here's some quick rules of thumb. Leadership inside companies, generally, they tend to focus on earnings, but especially on EBITDA. That gives them cash to actually do stuff with. Vendors typically are more likely to look at what's called the quick ratio and the current ratio. And they're similar. Quick ratio says, you got this cash and receivables. That's money that you can pay with. And how's that compared to money that you owe, the short-term liabilities? And that's a quick ratio. And if the number's high, it says, oh, they're going to be able to pay me back. If the number is below 1, it means this could be at risk because they owe more than they got on hand short term. A lot of vendors look at that. Some vendors who I would call strategic vendors. ones that they're in there for the long term. They know occasionally you're going to have some bumps in the road. They may also look at what's called the current ratio. And the only difference between that and the quick ratio is they say, I know that inventory might not turn into cash as quickly, but it's going to turn into cash. Or, for example, if I'm a roofing contractor, it's not inventory necessarily like rolls of goods, but it's work in process, right? You've already paid the labor, you put in the labor, you put in the material, a portion of that roof is done, right? You know you're going to get your cash for it, you just haven't gotten it yet, right? The vendor view. What about the shareholder view? Well, different views. Typically, the PE ratio, the price of the stock versus the earnings, a lot of just everyday shareholders, investors, people like us, everyday people on Main Street, they generally look at that. That generally reflects, to a degree, the value of the stock. The EBITDA multiple, frankly, most, not all, acquisitions, private equity, major companies buying each other, frankly, those are typically a multiple of the EBITDA. And here's why. You think about it, what are you really buying? You're buying a cash flow that's being generated from everything's being done. And the cash is the only thing you can make major decisions with. Most companies are actually purchased based on the EBITDA. Debt equity ratio, quick win, that just shows how leveraged they are. How quickly or not can they get access to more capital, right? You guys probably won't have to deal with that. And then you've got what's called the market cap, which is, the amount that if you sold my stock today and you sold my debt today and you add what's the value of those compared to what's on the books, balance sheet. Sometimes those are different. Again, that's more sophisticated buyers, right? Couple rules of thumb. Big, solid companies, rule of thumb, Wall Street overall, you'll find the price of stock relative to the earnings, generally in the 14 to 17 range. When it starts getting up over 25 is when you might want to start worrying about the market falling down. And in terms of EBITDAs, rules of thumb, retail's generally in the 5 to 7 range when they get acquired. Manufacturing tends to be a little more solid in the 8 to 12 range. High tech, because they're not really buying it for the EBITDA, they're buying it for the long-term potential. I mean, those are huge numbers, right? Now, let me go to another part of this whole finance thing, and it's a warning, right? I'm going to just tell you my experience. I don't mean this negatively, but I've been involved with a lot of sales teams, really good ones. I've never had a salesperson come to me and say, Dave, we lost the sale because I didn't sell the value. Never had that. Typically, when a salesperson tells me we lost the sale, they tell me, Dave, we lost the sale because either A, our price is too high, or B, we didn't have what the competition has. And every salesperson, I would if I was on commission, I want my price to be so low I always get it. And I want to have everything we've got that some people don't have, some of it, and everything my competitors have. Well, it's a business equation that generally doesn't work anyway. Here's a couple of lessons I learned once I got to more senior level. I wanted to get a salesperson out of my office. I just told them either their price was too high or they didn't have what the competition had, because that way it's not their fault. It's their company's fault, and they'll get out of my office. If I tell them anything but those two things, they won't leave. All right. Let's take that to the next step. So let's say, and this is how this chart comes in, salesperson comes to you and says, Dave, if we can just lower the price a little bit, I can sell a lot more. And let's say the product, the service is $10,000. So what do you mean by a little bit? Dave, if we lower the price by 5%, just $500, small amount, we can sell a ton more. And I pull up my little chart here. You can use this chart, right? And so let's look at it. The top section says, okay, what's my margin that my business operates on? And let's say, I'll make it up. I'm a commercial contractor. And typical commercial contractor, especially in not new construction, but in, fixing buildings and fixing homes, all that kind of thing. Let's say they're working on a 30% margin. Take my little chart with the 30. I slow it over to 5%. You know what that tells me? That tells me if I lower my price by 5%, I have to sell 20% more to make the same amount of profit. Not even improve, just make the same. I go to myself and I share with the salesperson. You're not positive you can sell a lot more than 20%. I don't want to do this because if you only got a 20% increase in sales, I'd have 20% more headaches, 20% more problems, 20% more people, and I'm making the same profit. Why would I do that? But then I turn to them and I say, wait a second. I know as salespeople, you don't like to do role play. And I know we don't like to talk as much about what can we do a little different than the competition. We can do something a little different that adds value to the customer. Maybe we can get a slight premium price. Now, say if we do more role plays, if we focus more on how we go to market, if we focus more on relationships, if we focus more on developing trust, if we focus more on differentiating from our competition, and we charge 5% more, in other words, instead of average 10,000, we charge 10,500. And we're at a 30% margin. Look at my chart and say, we could lose 14% of our customers and make the same amount of money. So if we could do all that and even just stay the same, none of our customers would leave us over the 5%. Now we're way ahead of the game. Wow. All right, do a quick summary or go on. Investors are those at risk. It comes from the long-term liabilities, the debt. It comes from the equity, the shareholders, cash they put in, or the money that was left in the company that was theirs, it was reinvested. Assets, well, that's what I need to run the business. I need a certain amount of cash, a certain amount of receivables, a certain amount of inventory, a certain amount of equipment and building to actually do the business. And I got short-term liabilities. That's the almost sort of free, that's the vendors. I don't have to, when I got to pay them back for the inventory or whatever it is I'm getting from them. My net investment is my total assets less people I got money from, sort of. They're not really at risk, the vendors. And that net investment happens to equal investors, those at debt. Same math. My EBIT, my earnings before interest and taxes, but what I really love to look at is the EBITDA. How much cash am I generating? So overall, how do I add value? Overall, it's increasing my RONA and not increasing my risk. Or it's decreasing my risk and not decreasing my RONA. RONA is the core to the group of investors as a business, right? Anything I do that increases income, profit after tax from the balance sheet, from the income statement. Anything I do that decrease in net assets, that's right off the balance sheet. That's how well I played the game of business. And we won't go into here. There's some key ratios you may want to look at. But now we've talked about the game of business. Let me demonstrate it. I've got this company called Tonstoffel. Yeah, I know it's a little bit weird name for it. We're going to call it Tonstoffel. And this company, I'm going to show you some numbers. This happens to be their income statement. I rounded it out. This happens to be their balance sheet, right? I'm doing about $5 million a year. That's what they gave you. It's making a profit before tax of $100,000 and a profit after tax of $70,000. Okay. What does this tell you? Not a lot. You know what their sales are. You have some key numbers. It doesn't tell you a lot about this business. All right, so what might I do with that? Well, I can do a little bit of analysis. And what's my cost of goods sold? Oh, that's the 3,000,006 divided by the 5,000,000, 72%. And then what's my gross margin, right? Which is, versus the 72. Well, sales less than 72%, get to 100%, it's 28%. So my gross margin or my gross profit is 28%. Remember, gross profit is in dollars, gross margin is in percent. Doing against the same thing. My fixed expenses, well, I had 1,000,001 divided by the 5,000,000, that's 22% of sales. My variable cost, that vary with sales, is a small amount, 4%. Interest, well, I don't have any debt in this case. I got a 2% profit and a 1.4% profit after tax. So now I've got a little bit better perspective on the income side, the return side. Then the balance sheet. Oh, I got 1,250,000. If I subtract the short-term liabilities, I've got a net assets of 750,000, which happens to equal the combination of long-term debt, which is zero, and what the shareholders put in, paid in capital and returned earnings, right? And I got net assets of 950. So I got invested 950,000, right? And I got my accounts receivable days, right? So how quickly am I collecting money? And it's 29 days. And that's just taking my sales divided by 365, right? My accounts receivable. My inventory, how much I got, or how much, if it's construction, how much is in place that I've completed, haven't necessarily collected for, 80, right? And that's just my inventory divided by my cost of goods sold. And my payables, how quickly am I paying people? It's 30 days. That's just my accounts payables divided by my cost of goods sold, right? Okay, I'm starting to get a better feel for the business. Now I look at, well, overall, what does that mean? Well, my return on just the shareholders for the shareholders is 70 divided by the 950. I'm getting a 7.4% return. My RONA, since I have no long-term debt, it happens to be the same as return on equity. It's also 7.4%. Well, one question you may ask yourself, if you were an entrepreneur, you got a pretty good business. If I'm investing back in the business, I'm taking risk. I'm making a little over 7%. How excited am I about putting more money back in my business versus maybe I ought to take some of that money in dividends and invest it elsewhere? Now let's go a little further. What if I made some small changes in this business? Can you tell me if these are pretty small changes? One, all right, I'm going to increase my income. And the way I'm going to do that is I'm going to, my cost of goods sold now is 72%. Man, if I work real hard, could I get that down to 3%? Not a big amount. If I reduce my investment, now it's 80 days, I could get it down to 70, knock it down just 10 days. Get that a little better, managing a little better. What if I could collect my money just a little bit faster from the 29 days and get it down just a little quicker, 2 days? What if I could stretch my vendors a little bit? Right now I'm paying them 30 days. I'm going to pay them in 35 days. If I did one more thing, I'm going to take some money out of the business, out of retained earnings, and borrow $100,000. I'm going to take a dividend of $100,000 out of the business. I'm going to borrow $100,000 long-term debt. Let's see the effect of those small changes. Well, increase the cost of goods sold. 5 million times 3%, that's worth 150,000. The tax on that income about 45. So I've increased income by 105,000. My net profit after tax now gone up to 175. Or I reduce my investment. Well, decreasing the inventory, that'd be 100,000 reduction. Collecting quicker, that's be 28,000. Stretching my payables, that would be 50. My net equity goes to 772. And my new net equity, by the way, and that's the net assets. And then if I add $100,000 debt, my new net equity is 672. I took that out of retained earnings by funding it with long-term debt. And look what happens. Before, small changes. My profit after tax before was 70. Right? Now it's 175. My new net assets, it was 950. It's now 772. And my equity, the shareholder portion alone, now 672. So how well I played the game overall for investors went to around 23% from 7. And for the shareholders, I went from 7 to 26%. I'm telling you, if I'm an investor, I can make 26%. I'm going to look for all the investments, all the opportunities. I want to grow this company as rapidly as I can. And by the way, for the employees on a growing company, it's more opportunity, it's more investment in them, it's more bonuses, it's more everything. These were some very small changes. Notice, I don't have to memorize all the formulas. I focus on adding value. Anything that increases income statement, raise sales, drop cost of goods sold, drop expenses. I added value, increases RONA. Anything I do that increases investment, less cash, less inventory, quicker receivables, a little less equipment. Maybe buy used instead of new, towards investment, increases RONA. A few of those small changes can result in some huge increases. By the way, if you noticed, some people like private equity all of a sudden may like some industries that they didn't notice before. In Tom Stoffel, what does it stand for? There ain't no such thing as a free lunch. Want it? A little bit of reference material. Here's some things to think about. Here's a quick cheat sheet. Quick cheat sheet is if you want to get in all the ratios, what do they really do? And I look at the ratios really simplistically. Some of those ratios are designed to help me see on the income statement, are there any things that look like a trend may be switching and I got to look at it. Things are going well, how can I do more of it? It look like it might be going a little off course. How do I stop it? I got a bunch of ratios. At the end of the day, they're really focused on those ratios you're memorizing on the income statement with one purpose. Is anything going on that can increase sales, increase cost of goods sold, or affect expenses? At the end of the day, that's what I'm looking for. I got a bunch of ratios to let me know how the investment side's going. Yeah, I can memorize the ratios and inventory and receivables, whatever. I don't need to memorize the ratios. I just need to see if I'm going off track or just get people focused on anything I do that lowers the investment, increases my success. That's the game of business, and those are the equations for it. Summary today, the financial game is all about risk versus return. Higher the risk, more reward there's got to be. 2, it's about earnings, right? All about earnings more than the cost of money. If I get returns, earnings, more than the cost to play, I can go back for more. 3, you don't have to get into all the details of all the numbers. Sometimes the back of the envelope, like we did with Tom Stoffel, can tell you a lot and take you a long way. And frankly, spending all that time with a lot more detailed numbers, just waste time. 4, about leverage. Think about it this way. The cost of my shareholder money, high cost money, is a lot more than debt. Why would I want to use high cost money for a low risk item? Let's say I own a contracting firm. I need another truck, and I happen to have a lot of cash in the bank. But that cash I'm valuing at, let's say I need a 15% return. But it's a low risk investment. Even if I got the cash, I'm better off leaving that cash alone, borrowing to get the truck at 6%, which after tax costs me 4%, and either use that money in the business to take advantage of opportunities or take some of that cash out, diversify my portfolio, but invest it in some moderate risk investments. And I'm better off. Another quick lesson. Be careful of sell price. Oh my God, it's like a drug. Only lower by a little bit, I'm going to make a lot more money. I've always found in general business, focus on value. And I define value this simply. People have other options. Shareholders have other options. Employees have other options. Customers have other options. I want to be, in enough cases, their best option to play the game of business. How do I be their best option and make more money? Deliver what they expect versus their other options, but have a couple of differences that their other options don't have. That's value. It may be in, say, employees. I treat them. It doesn't have to be financial. I treat them. The atmosphere is like, the environment's like. Might be with customers, extra features, a warranty, whatever it is. What am I doing? It's different than my competition because here's simplistically value, whether it's shareholder, employee, or customers, right? They have other options. I add value. I make my money on value based on my differences. And if I don't have differences, I'm competing as a commodity. If I'm competing as a commodity, I'm competing more on price. If I'm competing more on price, I'm making less money. So I hope this was helpful. I hope this gave you a better idea of the game of business. If you got questions, let me know. Thanks.